And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
So, good morning and welcome to, get ready to wrap up the week of last week of August, right? Get ready for September. Monday, Labor Day, of course. So we'll have a holiday shortened week next week for trading. And of course, Friday was the big news. That was the Jackson Hole Summit. Jerome Powell making his speech and clearly stating, he says, the time to adjust policy has come. So this is pretty much as clear of a statement you're going to get that the Fed will now start cutting rates. The markets like that on Friday, had a nice rally. And now markets are, setting to approach all-time highs this morning. And again, this is going to be something that the markets are going to deal with here over the next couple of weeks, in particular as we head into September at that next meeting, which will be coming in the month. And that's where the Fed will supposedly, at this point, cut rates. A lot of that, of course, will depend on data. The Jerome Powell did kind of default back to we're remaining data dependent. Now, right now, expectations are the Fed's going to cut rates by about 105 basis points between now and the end of the year. So technically, the market's expecting 4 rate cuts, 25 basis points each. But to get there, right, to get 4 rate cuts with 3 meetings left in the year, one of those is going to have to be 50. So again, we'll see what happens. I don't think the Fed will cut 50 basis points in September. We'll see. The data, is weaker. We are seeing weaker economic data on several fronts. Retail sales, of course. I just published a piece on Friday talking about retail sales. Despite the fact that the retail sales number was up strongly for the month of July, underneath the surface, and this is the case with a lot of this data, the data was not nearly that strong. Again, the consumer really started to slow down here. But again, what the Federal Reserve is going to look at is that headline number, not just that, but also employment and everything else is going on. So before the next meeting, of course, we'll have another CPI report, we'll have another employment report, and depending on what's going on with those numbers, that will certainly drive what the Fed does the next meeting. But still, at this point, expecting a 25 basis point cut in September. We'll see when we get there, okay? But markets are certainly, getting a little bit overly excited about rate cuts as we head in towards the end of the year. Now, also, we have the election coming up as well. So again, that still poses a threat to the markets. And then, of course, the dollar, which has been actually getting a lot weaker here. We've had a decent correction in the dollar here over the last few days, particularly because of what's going on with the Federal Reserve, and the Federal Reserve talking about this. We've had a fairly steep decline in the dollar. The yen has been rising. So that risk of that whole yen carry trade blow up that we had just 3-4 weeks ago that really kind of roiled the markets, that's not entirely behind us yet. Japan is still threatening to hike interest rates in Japan as long as it's warranted, right? And here we are cutting rates. So that whole carry trade, what makes up that carry trade, rate spreads, currencies, that's certainly kind of working as opposed to the carry trade itself. So again, that risk of another unwind of that carry trade is still out there. Now, again, a lot of that margin has been reduced from just a couple weeks ago. So, but the risk of the overall carry trade is still certainly present and can certainly, crop up and see a sharp decline in the markets again because of that issue. But we'll see what happens when we get there. But outside of that, not a lot going on this week. Earnings are pretty much wrapping up. The only big news this week, of course, is Nvidia in terms of earnings. They report tomorrow. So that's going to be the big market moving event this week. So goes Nvidia, so goes the technology sector. Expectations, of course, are very high that their report will be good. So there is a risk of disappointment from Nvidia this week. So again, just that's going to be the one thing that could really kind of roil the market is if for some reason they come in with extremely soft guidance, a big miss on earnings, a guide down on forward outlooks. I don't expect that to happen, but everybody doesn't expect that to happen. And as is always the case, when everybody expects something in the market, something else tends to happen. So again, just be a little bit cautious tomorrow because of that report. Okay, here's what you need to know before the bell this morning. The market, as I said, the market is looking to actually push to new all-time highs right now. We're very, very close to that, just a hair's breadth away from the market reaching an all-time high this week. So again, that's certainly very bullish. Breadth has improved markedly for the markets itself. So again, a lot of the things that are going on. We saw a big breadth thrust recently where breadth had sharply improved in the overall market. The 10-day rate of change has been extremely strong. And the advanced decline line, we had 10 times more stocks advancing on Friday than declining. That's a very bullish signal, at least in the short term. That generally says that the markets are back in a bullish trend. Concerns or fears about a decline or a recession certainly kind of fading into the back right now. The market currently is pricing in a 0% chance of a recession at the moment. The market looks ahead about 6 months. So again, on a very strong buy signal, markets are approaching all-time highs. A breakout here would certainly be very bullish, absolutely confirming that the correctional process is over if you do break out to an all-time high. But the markets are starting to reach more overbought levels here, at least in the short term. So again, we may get up here towards this peak right here to an all-time high. That's going to be a decent resistance level, and then you get a bit of a pullback. The market needs a break here to provide you a little bit better opportunity in terms of adding exposure to portfolios. The other big thing that jumped out to me this weekend as I was doing kind of my research for the newsletter was gold. Gold has had a very nice run here. Breaking out, it had broken out to an all-time high. The bullish trend here has been, kind of gold has stagnated here for a while through June, July, and then recently broke out here to an all-time high. So that's very bullish. Gold is getting overbought like the markets. But here's the thing that really jumped out to me. If we jump out to, and look at gold on a very long basis, and again, kind of look back. Now, this is a monthly chart, so the only thing that matters is where it closes at the end of the month. So when you're looking at monthly charts, it's always end of the month data that matters. But here's the thing that really kind of jumped out to me, and I haven't seen this in a while, is the fact that we're now back to extremely overbought levels. And again, now this is a monthly basis, so this takes a really long time for these kind of overbought conditions to occur. But here's the thing that really kind of jumped. When you got very big deviations in terms of overbought conditions as well as very elevated levels of MACD signals, that has typically corresponded with a more important peak, at least in the short term, with gold prices. So again, if you're long gold, that's great. But commodity traders in general, which is what drives the price. So nothing else drives the price of gold. Gold is a commodity. The only thing that moves the price of gold is what happens on the NYMEX. So that's all the commodity traders. That's what moves the price of gold. Everything else is coincident. So when you hear people saying, well, it's the money supply, it's the deficit, it's the debt. No, those are coincident. Those are things that occur because of coincident nature with a rise in gold prices. But what drives the price, buyers and sellers, that happens on the NYMEX. NYMEX traders are extremely long their speculative positions in gold. And in fact, we haven't seen such a long position in speculation on gold going back. We have to go back to 2020, which was that peak, and basically 2013, 2014, which was this peak. So again, you're at levels in gold that have historically been associated with market tops in that commodity price, at least on a short-term basis, a year or so. So again, don't forget to take, as is always the case, right? Just don't forget to take profits, rebalance your position. It's been doing very, very well. It's been a really good performer this year. It's up about 22%. It's been great, right? But don't forget to take some profits, rebalance your weightings in your portfolio. As always, just like with stocks, works the same in gold and everything else. So that's, like I said, just something that jumped out this weekend. That's what you need to know before the bell this morning. We come back, we're going to pick up with talking about the bullish signals in the markets, along with a lot of other things this morning. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Building anything of substance requires careful planning, including your retirement. You need a blueprint to structure your funds against volatility and turbulence in the market. If you fail to plan, you plan to fail. Richard Rosso and Danny Ratliff share the RIA Retirement Blueprint. Saturday, September 14th at the Hyatt Centric in the Woodlands. How to structure your savings, level your risk, and craft a secure future. Register now for the Retirement Blueprint with Ratliff and Rosso at realinvestmentadvice.com. Realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So a couple of things to get into, of course, as we discussed in this weekend's newsletter, the market's doing fine here. Assets in general are doing well. Market breadth across markets, whether it's gold or, as we were talking about a second ago, whether it's gold or stocks or equal weighted indexes, everything's been doing fine. There's been a lot of consternation about, bearish headlines. And as I noted in this weekend's newsletter, it's extremely easy to find bearish headlines. I just did a quick, Brent, if you can bring this up for me. I just did a very quick search. I just hit Google and I said videos on bear markets, and a big stock market crash is coming. The 2024 stock market crash just started. This is what always happens before a stock market. I mean, so lots of videos and commentary out there, all suggesting that the end is coming. So you better be in this, that, or the other thing, right? Short markets, whatever. But there's really no indication of that at all right now. If you take a look at a variety of different signals, as we were talking about a second ago, Friday's a really good example of this. On Friday, you had 10 times more advancing stocks than declining stocks. That's extremely strong breadth. You don't get that kind of breadth heading into a bear market. So, this is one of the challenges with managing money or assets of anything is that, when all assets are moving together, and again, this is the interesting thing, and this is another kind of interesting byproduct of gold. Gold has been a coincident performer with stocks, right? So everything's kind of, in other words, gold is supposed to be kind of your risk off position. So when something's going wrong in the markets, then you're in gold, right? And this was kind of an interesting byproduct of what's happened over the last really kind of 4 years. Gold has performed very well. Brent, if you can bring, let me see if I can make this. See if you can bring that chart up for me. What this is market performance over the last 4 years. So this is everything. Now, what you'll notice is that everything went up going into 2022. Everything went down in 2022 together. and everything went back up again. So, so in other words, what's been going on here is we've had highly correlated markets. So it doesn't matter what you own, you've been making money with it. And that's great. To my point though, all these people are out there going, oh, the bear market's coming, you better be in this, or the bear market's coming and you better be in that. We have inflation, so you better be in gold. Well, gold didn't perform well in 2022 as we had 9% inflation. It's performed well recently, extremely well, because markets are rising. So there's this big flood of money into all assets. And this is a bit of a frustrating part because everything else is thesis, right? Well, this is going up because of this, or this is going up because of that. No, everything's going up because there's a flood of money going into assets all across the board. And there's so much money out there chasing so few assets, it's just driving prices. And so you got highly correlated markets right now, which is fine because it means whatever you own is going up. That's okay. But highly correlated markets are problematic because if you do eventually if you do get this downturn, right, everything goes down with it because everything went up with it. And that's going to be the big challenge for investors, which is there's really no safe place to hide. And that's one of the big challenges that investors will face if or when these forecasts of a major bear market comes. Because when everybody's piling into every asset class all at the same time, they also come out of every asset class all at the same time because it's the baby with the bathwater. Oh my gosh, this just happened. I got to get out. And so that's what will happen. And we saw this again, specifically we saw that in 2022. Everything was coming out at the same time because everything had run up at the same time as well. And so this is one of the things that is important to keep kind of in the back of your mind. And this isn't new, right? This has been going on for a while. But when you keep seeing all of these really bearish headlines out there, and they're easy to find. I mean, they are super easy to find. You just type in bear market and you'll just get one, running list of videos and articles and everything else about how the next major bear market is just on the cusp and you better be in whatever product they're generally selling. Just be careful with that. And so in this weekend's newsletter, I just kind of reprised a bit of an old article that we had written previously talking about kind of this psychological nature of investors. And if you put an order of events on a bell curve and look at standard deviations of events, these economic outcomes that are extremely disastrous, the things that, destroy, capital and set us back, years in the financial making, they're possible, but they are not probable. Things that tend to happen more often than not fall within the realm of normacy. And those are the things that we need to manage risks for. And that just means, taking profits when you have them and rebalancing risk as you need it. And again, that process will protect you better over time than piling into some asset class because, oh my gosh, economic doom or gloom is coming, so I'm going to be in this asset. And the problem is that if you're piling into an asset that is supposed to protect you in the event of doom and gloom, it should not be performing today. If everything is great, the asset that is going to protect you from doom and gloom should not be performing. It should be sitting there like a dead duck, and just not moving because you want it to move when everything else reverses. So if you're piling into some asset going, well, I want to be in this asset because in the event that the world comes to an economic conclusion, this asset is going to perform the best. The problem is right now, everything is going up. So if everything is going up, correlated assets, they're going to go down together. as well. But again, let's talk a little bit about bullish signals, because this is really kind of the driver of the markets right now. Because again, there's not any indication at the moment that the markets are on some cusp of a major reversion. The 10-day rate of change in stocks is extremely elevated right now. That happens really actually coming off of market bottoms more often than not. You're seeing this is that return of capital coming back into the market. So you see a very rapid rate of change in price. That is normally the beginning of a bullish move, not the end of one. So again, this is just, and this, applies to the same thing with a Zweig breadth thrust. And what this chart shows you is that historically, when you have a breadth thrust, so this is different. So this isn't price moving up quickly. This is the number of stocks that are all moving up together. So when you have an increasing number of stocks performing, these breadth thrust are coincident with rising markets. We talked a little bit about this last week, but historically this corresponds with market lows, not market peaks. And again, supports this idea of a more bullish move in the overall market. And of course, lastly, now with the Fed cutting rates, again, starting this month, we've got global central bankers really pretty much in line with cutting rates. We're starting to see global liquidity turn back up. And global liquidity is a driver for markets. And again, you're seeing, you kind of go back to, if you take a look at global liquidity, you see that downturn in global liquidity heading into 2022. It bottomed in October of 2022, along with every asset class. Every asset class, gold, stocks, bonds, everything else, bottomed in October of 2022. Since then, as global liquidity is increasing, all assets are now increasing with it. So again, there's nothing currently today that suggests a bear market is right around the corner and you better go hide in safety and have a bunch of cash and T-bills. Now, does that mean there's no potential for a correction? Absolutely not. That's not what that means at all. We're going to have 5 to 10% corrections regularly. This is going to be kind of a new dynamic we're going to see. We may have another 5 to 10% correction before the end of this year. I don't know, but it's certainly possible. Those are going to be more regular events because of the way the markets are stacking up right now. But the risk of a 20 or 30% correction or a 40% correction or a 50% correction, is that possible? Absolutely. Right? On that bell curve, it is certainly a possibility, but it's a more remote one. And it's one that right now the markets are not aligned for because, again, the breadth of the market, the advance of the markets, the participation in the markets, the absolute correlation between all asset classes in the markets all suggest that there's a lot of money coming into the market, not coming out. And those things don't reverse overnight. All right, quick break. We'll come back. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Building anything of substance requires careful planning, including your retirement. You need a blueprint to structure your funds against volatility and turbulence in the market. If you fail to plan, you plan to fail. Richard Rosso and Danny Ratliff share the RIA Retirement Blueprint. Saturday, September 14th at the Hyatt Centric in the Woodlands. How to structure your savings, level your risk, and craft a secure future. Register now for the Retirement Blueprint with Ratliff and Rosso at realinvestmentadvice.com. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
You have to love Texans, and you have to love Texans back in the 70s because we didn't really know better. You take a big propane tank and you stick it in the back of your truck and make the connection to your car so that you have propane-fueled engines because propane was cheaper than gas.
The Real Investment Show podcast.
Gas was almost $1 a gallon. It was outrageous.
Same show, your schedule.
You were a mobile bomb, but
at realinvestmentadvice.com.
But you didn't have to pay for gas. Oh, man.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
Building anything of substance requires careful planning, including your retirement. If you fail to plan, you plan to fail. Richard Rosso and Denny Ratliff share the RIA Retirement Blueprint. Saturday, September 14th at the Hyatt Centric in the Woodlands. Register now for the Retirement Blueprint with Ratliff and Rosso at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So tomorrow we're going to get more into some technical analysis on the markets, but I want to talk a little bit about risk management this morning because I apologize to you, by the way, because two things, two apologies this morning. One, this morning I said during the open that Nvidia reports tomorrow. It's Wednesday. They report Wednesday, not Tuesday. So apologize. But the second apology comes from the fact that a week or so ago, we were on the show and we were talking about risk management, and I never went through the rules. And I forgot. We got off on talking about other things, and I forgot to give you the rules. So I thought we'd touch on that a little bit this morning to make up for that that oversight on my part. But it kind of popped out this weekend. So in the newsletter, so the Bull Bear report we produce on Saturdays. So it's free. It's on the website, realinvestmentadvice.com. All you have to do is go to the front page, realinvestmentadvice.com, submit your email address. We'll email it to you on Saturday. But at the bottom of, we write a piece about the markets, and then we go through a lot of analysis on the markets, technical, fundamental, whole variety of things. And one of the things that we produce is a table on market sector relative performance. And this is very handy for week-to-week management of your portfolio. Now, this analysis is daily. It's very short-term in nature, but it tells you when markets are extremely overbought or extremely oversold. And so if you're trying to figure out when to take profits or when to increase exposure, this analysis can really help you. It gives you a good bit of analysis about, kind of the overall markets, what performance is by sector or by market, kind of year to date. In fact, let me just bring up that chart real quick. Brent, I'm sorry about that. I'm messing Brent up over here. Just But again, just kind of while we're talking about this, so you can kind of get a better understanding of this other chart I'm about to show you. You'll get a better feel for this analysis. 1 second. Here we go. So this is the total chart that we produce. So this chart has this table has 6 quadrants to it. In the upper left, it gives you. Oh, sorry. Just stay right there. They keep adding new features. Yes. Messes me up. These automatically rotating things. So it is AI. So the first upper left, year-to-date performance. So this just shows you what the year-to-date performance is of every major market, every major sector, kind of across. So it's bonds, it's international markets, all the sectors of the S&P, et cetera. The table to the right of it is the day-to-day. That's a daily chart of all those sectors, markets, year-to-date. And they're all rebased to 50. So you see relative performance of the markets relative to the S&P, which is the black line. Now that's just kind of the normal analysis. So, right now the market's up, 18.27% for the year. And so you can see what sectors are performing as much as the market versus those that aren't. Now, where the analysis gets a lot more interesting is in the middle section. And that shows you that this is year-to-date performance relative to the S&P 500. The only two kind of sectors and markets right now, or sectors, right, that are beating the S&P 500 this year are utilities and communications. Everything else is underperforming. Now, for utilities to kind of be leading is also kind of interesting because utilities have been a big lag over the last couple of years. So they've been performing better this year. The chart to the right of that in the middle is the price deviation from the 50-day moving average. And when prices get more than 4% above the 50-day moving average, those are typically areas or levels where you tend to see profit taking and markets tend to correct those sectors a bit. Which brings us to the bottom left panel. This is the one I want to focus on today. Now, the bottom right panel, that's just the high and low for the year. So as you can see is that most sectors are trading at their high for the year. Now, the one to the left of that, though, is most more. This is the Williams %R indicator. And this just is basically an overbought, oversold indicator for the markets for the week. And now I'm gonna give you the other chart here. Well, that's fine. We can just do this one instead. That's fine. That's good. When markets or sectors are at the peak, they're overbought, and you typically get a reversal in those, and it's almost like clockwork. If you look at these over time, and we're going to go into more detail on this tomorrow on the show, but if you look at these on a long-term basis, they cycle from the top to the bottom, top to the bottom, top to the bottom. So when they get overbought, that's a good indication it's time to take some profits. When they get to the bottom, it's a great time to start buying stocks. And if we go back and look at, and we will tomorrow, we'll go back and look at this at the peak in July, where we were, versus where we are today, right? So what this is telling you right now is that everything is now overbought. Everything is now overbought. And we talked about last week, for instance, you can't buy bonds here. Bonds are too overbought to buy. So we're going to get a reversal in yields short term. Could be a rise in oil prices. It could be, a hotter than expected retail sales number in September, which is very likely because of back to school shopping. Could be a variety of things that puts some fear into the market short term that inflation might come back, right? Or maybe the Fed won't cut as much, whatever it is. But there'll be something that causes yields to reverse because they're extremely overbought here. So as yields reverse, obviously, so will bond prices. These other sectors, if yields go up, then utilities, real estate, those sectors that are interest rate sensitive are going to come down. The market's overbought. It's going to come down, and when it comes down, it'll pull all the other sectors down with it. So again, whatever causes it, whatever headline causes that reversion, we're going to see this reversion. But this is why risk management is important in what we talk about. As I mentioned this morning, if you and as I was doing analysis this weekend, I hadn't looked at a monthly chart on gold in forever, and to see those extreme deviations in gold price was kind of a early warning call. And then we have a portfolio that has gold in it, so we'll be taking profits in that. But that's just risk management. And so this is why I wanted to come back. If you can just, Brent, pull up everything down to that bottom bolded sentence from the rules down. Just kind of give me a square. We'll just kind of go through those. But this is why risk management's important. And again, remember where people tend to go wrong in managing their portfolio is that somebody says, well, this is overbought or this is oversold. And so they make, thank you, sir, they make big one-sided bets, right? I sell everything. Oh, Lance said that, gold was overbought on a monthly basis. I'm going to sell everything. No, that's not what that means. It doesn't mean that things can't keep going up, and they will over time. Gold has been going up since the turn of the century. Well, that sounds like a long time. Back in the 1900s. I mean, gold's been going up since the 70s, right? You go through periods, though, with gold is a good example. Like, for instance, in 2008, gold declined with the markets. It didn't go down as much as the markets, but it corrected. Then in 2009-10, it rallied a good bit as we were doing QE and those type of things. So we had a speculative push of gold. And then it went nowhere for a long time. It just was stuck. So for quite a few years, you made no money with gold, right? And other asset prices were rising. But it just went nowhere. So it just kind of stagnated for a while. And then it's recently had a very, very good run over the last 4 or 5 years. So that's completely fine, but that's why you never sell everything. Sometimes things go into a dormant phase, and it's like, I still want to own this. It's got a fundamental reason why I own it, whatever it is, but it may not be making you money for a while. It could be dead money, and that happens with all assets. All assets have these phases where they are literally dead money for a decade. You take a look at individual stocks. There are stocks out there that they throw off a dividend and they go nowhere. Price wise, they don't go up or down a whole lot. They just throw off a dividend, and that's okay, right? It has a place within portfolios. All that does. So no asset is good or bad, but you still have to manage the risk because these assets, all assets, have corrections. Nothing goes up indefinitely. Nothing goes down indefinitely. And so risk management is very important. So let's go to the rules. So these are the rules. And I meant to go through these with you, I think it was last week, and I apologize. So again, I'll make it up for you real quick. But there's 4 primary rules, right? Which is basically raise portfolio cash levels to lower your volatility. So if you're concerned about a big market downturn, that's what these rules are, right? So again, markets are overbought on a short-term basis. We need to think about, managing risk because the markets are going to reverse. Whether it's gold or stocks or whatever it is, you're going to have a reversal in prices at some point. Again, 5 to 10% doesn't mean the end of the world. Right? We're not talking about, as we noted earlier, right? Plenty of bearish headlines out there, but there's nothing data-wise that suggests a big bear market is on the horizon. But a 5 to 10% correction, definitely on the horizon because markets are so overbought right now on every front, whether it's gold or stocks or bonds, everything is overbought. Everything is going to have a correction. So we'll come back. We'll go through the rules and we'll talk about managing risk on a longer term basis in your portfolio as well so you can sleep better at night. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Building anything of substance requires careful planning, including your retirement. You need a blueprint to structure your funds against volatility and turbulence in the market. If you fail to plan, you plan to fail. Richard Rosso and Danny Ratliff share the RIA Retirement Blueprint, Saturday, September 14th at the Hyatt Centric in the Woodlands. How to structure your savings, level your risk, and craft a secure future. Register now for the Retirement Blueprint with Ratliff and Rosso at realinvestmentadvice.com. Realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show. So just going through the rules here. Look, every asset class is overbought right now. Whether it's gold, bonds, stocks, international markets, emerging markets, you pick it, it's overbought. Exception of the dollar, which is going through a decent correction right now. But every investing asset class, things that most people don't invest just purely in the dollar. But most assets that people invest in their portfolios or 401k plans, et cetera, are all overbought simultaneously. This happens from time to time, and it generally precedes some type of corrective action. Could be a week, could be a month, could be 2 months, could be 2%, could be 5%, could be 10%. That's the range. And you'll have a correction somewhere in that range. Potentially, the Fed disappoints, Nvidia disappoints on Wednesday. That could cause a decent correction in assets kind of across the board. Oil prices rise for whatever reason. That impacts bonds. There's a variety of things that can go out there because, again, every asset class is overbought. So everything's going to correct. You can't buy bonds here, as we said. They're too overbought. You're going to have to wait for a pullback. Stocks are too overbought. Gold's too overbought. Everything's going to have a pullback before you can, which will give you an entry point. So, if you want to buy more gold or more bonds or more stocks in your portfolio, great, right? But you have to prepare for that. And this is one of my big beefs with buy and hold strategies. I take my money, I invest it into an index of whatever it is, and I just sit on it. Well, that's great, but when you have a really good opportunity come along, that means A, whatever value you had, you've given up a big chunk of that, getting to this great buying opportunity, but now you have no money to buy with because you never sold anything. So what these rules do is help you just kind of navigate the risk. And now none of this says sell everything and go to cash. That's not what any of this means. So again, Brent, if you can bring our rules back up. So the first one is to raise portfolio cash levels. And that doesn't mean sell everything, but right now in our portfolios, we're probably close to 20% cash at the moment in our portfolios. That's on both the bond side as well as the stock side because we're underweight both right now, waiting for a correction. So we've got cash to buy if the market corrects. And what having cash levels does, higher cash levels, again, not everything, shouldn't be 100% cash, But if you raise your cash levels a bit, when you do have the correction, it lowers that volatility. So now you're not pressured to do something. The market's down 2%. We wake up Monday next week and the yen's blown up again. The market's down 3%. Your portfolio wants to be down 3%. So now you're not pressured to immediately like, oh my gosh, I have to do something. This correction is here, right? Reduce your equity risk a bit, your commodity risk, whatever you're invested in. Just pull it back and take profit. So again, look at your portfolio. If your portfolio is 10% bonds, right, or 20%, 30%, whatever it is, think about reducing a little bit, right? So if your normal target, and let's just say that you've got 20% bonds in your portfolio, 20% gold, or whatever you own. That was what your original weight. When you bought it, you sat down and said, okay, I'm going to put, hopefully you theoretically thought about this when you built your portfolio. You said, I'm going to have this much money allocated to this asset class. I hope there was some thought process in there when you built your allocation. And assuming there was, you originally bought 5% gold and 10% bonds and 30% stocks, whatever. That was your original allocation. And now, it's 10% gold, it's 40% bonds. It's because they've grown, right? They've grown in value, whatever it is. Trim it back to that original weight. Again, don't sell everything. Just take your profits, reduce it back to that original weighting, and that gives you cash to spend. So when the market does correct, those assets will go down. And let's say I own gold and I originally bought 5% of my portfolio on gold, and now it's 8%. I trim it back to 5%. Gold prices go down. It's now 3% of my portfolio. I then buy it back up to 5%, right? Helps you manage that risk over time, but gives you an opportunity to buy things when they're cheap, which is our goal. Our goal long term is to buy low and sell high. Add or increase to duration of bond allocations. Again, you can't do that right now. Interest rates have to have a correction, but again, but adding bonds to your portfolio, if you don't have exposure to bonds in your portfolio at all, consider adding them on a pullback, because as the economy slows, bond prices will improve. But they also offset the risk of financial events because money will flow. And then we're talking about treasury bonds here, not corporates. In the event of a risk-off event of magnitude, bonds will perform well because, as you saw during the yen carry trade blow up, everything went right into treasuries that day. That's your risk. That is your one place that every major manager goes to immediately when they don't know what else to do. That is the place of safety. They go to treasury bonds. So add treasuries to your portfolio. Again, you can't really do it now if you haven't done it, but you want to have some treasuries in your portfolio to protect you against a real risk-off event if it occurs. Again, and when you're expecting slower economic growth, which is where we are right now, commodities and inflation trades are going to underperform, particularly when they're as overbought as they are now. Everybody's been piling into these inflation trades over the last few years. Again, every asset class is correlated, so there is a fundamental driver between commodity prices of all types. So this is every type of commodity, whether it's oil, cotton, copper, whatever it is, there's a relationship to supply and demand. So reduce exposure to commodities in general and the inflation trades, because as the economy slows down, those are going to get more impacted than what you're going to see. Again, commodities in general, all commodities, they have no fundamentals. They don't have any fundamentals. They don't produce earnings. They have no dividend yield. So the only thing that moves the price is speculators on the NYMEX. That's why they call them speculators, because they're trading solely on price. So all commodities are a function of supply and demand of the underlying futures contracts. If that changes for whatever reason, that's where your big risk is. So if the economy is slowing down, there'll be less demand for commodities that will feed through. So the markets are bullish, but it doesn't mean that you can't have a correction. It just means that we're not going to have this massive, kind of bearish event that occurs. But what can you do is but if you're worried about that, if you don't believe me, that's okay, right? This is what makes a market. What can you do to hedge your portfolio against a bigger macro downturn should it occur? Well, that's have some excess emergency savings. If normally you have 6 months worth of emergency savings, take it out to a year and a half. Make yourself comfortable. Say, if everything goes to hell in a handbasket, I don't want to have to draw on my portfolio for the next 12 or 18 months. Have that in cash, sitting aside. That's in a money market account. It's not in T-bills. It's not in CDs. It's liquid cash. The reason for that is that during a downturn in the markets of magnitude, right, you don't want to be also drawing on that portfolio, right? If you need your portfolio for income to live on, you don't want to have to sell stuff during a decline because you accelerate the downturn in the portfolio relative to the market. So if the market's down 10, but you're also taking out 10%, you're going to really exacerbate that downturn in the portfolio, which is going to make it harder to recover. So in the event of a downturn, if you're really worried about that, have excess savings to draw off of so you can leave the portfolio alone. Extend your time horizon out to 5 to 7 years. So instead of worrying about what my portfolio is going to do this year or next, in the event of a downturn, I say, look, I'm going to look at these assets, and over the next 5 to 7 years, these assets will trade higher. They may go through this correction like we did in 2008. 2008 is a great example, right? Wiped out 50% of your portfolio in 2008, but within 7 years, most of that was recovered. So look at the assets you own. Are they good quality assets, right? Are they treasury bonds? Is it gold? Is it, high quality stocks? Those type of things. Those aren't going to zero. Now, if you own more speculative assets like, very small cap, newly emerging companies, a lot of those could go to zero. So make sure that you own assets that are of high quality and extend your duration out so that you can weather a downturn. Don't obsessively check your portfolio. One of the big mistakes, and we've talked about this before, psychology. Excuse me. Checking your portfolio every 5 minutes, every 10 minutes, every day, don't do that. Because if you do that, you're going to rope yourself into making emotional mistakes. You're going to buy stuff too high because it's going up. It's like, oh my gosh, I'm missing it. I got to get in. Or something's going down. It's like, oh my gosh, I got to get out. It's going down. Check your portfolio once a quarter. Look, I have to look at a portfolio every day because we have new clients coming in every day that I've got to, look at, analyze the positions they're bringing in. Do we need to sell those? Do we need to, trim them? Whatever. Do I want to add a new position to the portfolio? Whatever it is. So I have to look at things every day. That's my job, right? But for you, don't look. If you will slow down your portfolio checking to once a quarter, you will do much better because, again, things like 3 weeks ago, you see this headline, market's down 3% in the day. Your first inclination, sell everything, right? Market's crashing. 3 weeks later, it's back to all-time highs. If you didn't check your portfolio, you didn't make bad decisions. So don't check your portfolio every day. Always consider your tax loss harvesting. Do your sell losses that you need. Stick to your investment discipline. Don't deviate, right? The hardest thing to do is stick with an investment discipline. Not jump around, chase this, chase that, chase the other thing. Remain disciplined. All those rules, by the way, are in the newsletter this past weekend. So if you want to read them for yourself, go to the website, realinvestmentadvice.com. Download this week's Bull Bear Report, along with all the charts and graphs and technical analysis at the bottom. It's all there for you to help you manage your money better. Have a great day. We'll see you back here tomorrow. See you then.